The world's most powerful currency is showing signs of quiet fragility, yet global markets continue to treat it as untouchable. Nations are subtly diversifying away from the dollar, signaling a paradox few economists dare to state aloud. Despite the dollar's central role in trade and reserves, a growing number of countries are limiting exposure to U.S. treasuries. This cautious retreat suggests that confidence, once assumed permanent, is starting to waver in silence. Trade imbalances have widened for decades, leaving the U.S. running chronic deficits that are now impossible to ignore. The dollar's dominance masks an underlying vulnerability. Persistent fiscal overextension threatens long-term stability. Global reserve management is undergoing a quiet revolution as central banks experiment with non-dollar assets. The shift is slow, almost imperceptible, yet it carries implications that echo the decline of every dominant currency in history. Investors and policymakers are beginning to notice cracks in the system that textbooks rarely acknowledge. The paradox is clear. Strength in the short term may conceal weakness in the long run. Historical precedent offers a warning that few modern analysts fully digest. Every reserve currency, from the Dutch guilder to the British pound, eventually faced abandonment once fiscal pressures became unsustainable. Currency dominance is not a permanent guarantee, and early indicators often appear as minor adjustments in trade or reserve holdings. Observing these subtle changes provides insight into the potential trajectory of today's global financial system. Debt accumulation, when left unchecked, accelerates the erosion of confidence long before hyperinflation or default becomes visible. The patterns are subtle yet consistent, echoing through centuries of monetary history. Even as the US dollar enjoys its current supremacy, global actors are quietly recalibrating their exposure. This silent shift highlights a fundamental truth. Markets respond to structural weakness, even if headlines continue to celebrate apparent strength. The paradox of the dollar's dominance lies in its vulnerability hidden beneath the surface of daily transactions. Recognizing these warning signs is the first step toward understanding why nations are abandoning it in silence. Chronic sovereign debt accumulation creates a silent pressure that compounds over decades, often unnoticed until it triggers instability. Governments relying on constant borrowing risk, creating structural imbalances that monetary policy alone cannot correct. Persistent fiscal deficits force central banks to monetize debt, subtly expanding the money supply beyond sustainable levels. This process erodes purchasing power and lays the groundwork for inflation, even when headline rates appear stable. Credit expansion functions as a double-edged sword. It stimulates short-term growth but amplifies long-term vulnerability. The expansion of credit without corresponding productive investment generates financial fragility hidden in balance sheets. The interplay between debt and currency strength follows a recurring pattern observed in historical crises. When debt outpaces economic output, confidence in the currency begins to waver, often before official indicators register stress. Interest payments on growing sovereign debt increasingly consume national budgets, leaving less fiscal room for essential investment. This creates a feedback loop where borrowing fuels more borrowing, compounding systemic risk over time. Central banks amplify risk during periods of quantitative easing and low interest rates by incentivizing further leverage. Asset bubbles inflate while the underlying fiscal foundations weaken, creating an illusion of prosperity that can collapse suddenly. A critical mechanism in currency stress is the erosion of foreign reserves through persistent trade deficits. As imports exceed exports, nations increasingly rely on borrowing to finance consumption, exposing the currency to speculative pressure. Historical cycles show that fiscal overreach often precedes currency transitions. Nations rarely default suddenly. Instead, they undergo slow, observable shifts as confidence gradually migrates to more stable alternatives. Inflation is both symptom and signal. Rising consumer prices erode confidence, yet policymakers often respond with short-term interventions that defer structural reform. The delay allows debt burdens to grow while the currency's credibility quietly diminishes. Sovereign borrowing patterns exhibit clear thresholds beyond which markets lose confidence. Once these thresholds are crossed, even minor economic shocks can trigger outsized reactions in currency markets and bond yields. Diversification of reserves by foreign central banks follows predictable economic logic. When the risk-return balance of holding dollars becomes unfavorable, accumulation of alternative assets accelerates, signaling systemic change. The mechanics of currency abandonment are subtle yet detectable, often beginning with small shifts in trade invoicing and bilateral settlements. These incremental adjustments provide early evidence that a global reserve is slowly losing its unquestioned supremacy. Historical evidence shows that recurring patterns of debt accumulation, inflation, and currency erosion are rarely interrupted by policy interventions alone. Without structural fiscal reform, these cycles tend to repeat, often with increasing severity. The relationship between banking systems and sovereign debt is inseparable. Weak banks amplify fiscal vulnerabilities by overexposing themselves to government debt. Bank fragility can transform a slow-moving currency stress into a sudden liquidity crisis. Monetary policy failures exacerbate the pattern when central banks misjudge inflationary pressures. Over-reliance on interest rate adjustments or asset purchases without addressing structural deficits can accelerate the path toward currency vulnerability. Trade imbalances and geopolitical shifts often magnify economic fragility. Nations that run persistent deficits while accumulating foreign debt leave themselves exposed to external shocks that can undermine the reserve currency's dominance. Economic history demonstrates a consistent sequence. Debt growth leads to inflation, which erodes confidence and triggers diversification of reserves. The repetition of this chain is a pattern visible in almost every major currency decline of the last 3 centuries. The psychology of markets compounds the pattern as investors respond more to perceived risk than to official statistics. Even incremental changes in fiscal behavior or reserve allocation can trigger outsized effects when confidence wavers. Debt-driven expansion is often disguised as growth, making systemic risk invisible to casual observers. Analysts who focus solely on GDP growth without examining balance sheets miss the hidden erosion of currency strength. Understanding this pattern is essential to interpreting modern developments. The recurring mechanisms that undermine past currencies are now quietly reshaping the global role of the US dollar. In the aftermath of World War I, Germany faced a staggering fiscal burden, with reparations payments exceeding 132 billion gold marks. The Weimar Republic resorted to printing money to meet obligations, triggering hyperinflation that would soon devastate the economy. By 1923, the mark had lost nearly all value, with prices doubling almost every few days. Citizens needed wheelbarrows of currency to buy basic goods, illustrating the catastrophic result of unchecked sovereign debt expansion. Banking institutions struggled to maintain solvency as government bonds lost value, exposing systemic weaknesses in the financial sector. Credit became nearly impossible to obtain, and banks collapsed under the weight of both bad loans and worthless government securities. The German government attempted stabilization through the introduction of the Rentenmark in November 1923. This new currency, backed by land and industrial assets, temporarily restored confidence, but required strict fiscal discipline to succeed. Public confidence, once shattered, proved slow to rebuild, demonstrating that currency restoration depends as much on psychology as on policy. The Weimar example shows that debt-fueled money printing erodes trust faster than it can be repaired by monetary reform. Historical analysis reveals that the German case was not unique. The Dutch guilder in the 18th century and the British pound after World War II followed similar paths. Excessive wartime borrowing, combined with delayed fiscal adjustments, set the stage for rapid currency devaluation. During the British post-war period, the pound faced declining global influence as national debt surpassed 250% of GDP by 1945. To manage this, the UK imposed strict controls on spending and devalued the currency in 1949, highlighting the trade-offs required to maintain international confidence. In both Germany and Britain, inflation functioned as a hidden tax, eroding savings while allowing governments to service unsustainable debts. These historical patterns reveal the predictable consequences of fiscal overreach and monetary mismanagement. The Weimar crisis also demonstrates how banking systems amplify sovereign risk. As banks held vast quantities of government bonds, inflation destroyed both depositor wealth and institutional stability simultaneously. Hyperinflation in Germany fueled social and political upheaval, showing that economic mismanagement can have consequences far beyond finance. Confidence in governance and currency are inseparable. When one collapses, so too does the other. Lessons from France in the 1920s further reinforce this pattern. Post-war debt exceeded 150% of GDP, and repeated currency devaluations created cycles of inflation and deflation that undermined both growth and stability. French policymakers attempted to stabilize the franc by pegging it to gold, but the rigid system collapsed under speculative attacks. The inability to reconcile debt obligations with currency credibility illustrates the delicate balance required to maintain a reserve asset. Across historical cases, the cycle of debt accumulation, monetary expansion, and eventual currency stress is remarkably consistent. Economists studying these periods note that the warning signs, rising debt ratios, inflation spikes, and banking strain, are always present before collapse. Even short-term interventions, such as temporary currency pegs or fiscal austerity, often fail without sustained reform. The historical record emphasizes that systemic vulnerabilities accumulate quietly and only manifest in crises when thresholds are breached. The Italian lira in the 1970s provides another example of gradual currency erosion. Inflation averaged nearly 20% annually, fueled by government borrowing and monetary expansion, ultimately forcing policy interventions to stabilize the economy. Banking systems again played a central role as domestic banks were heavily exposed to government debt. When inflation accelerated, deposits lost value, lending contracted, and the economy slowed sharply. Historical evidence shows that once a currency loses international trust, restoring its global role is exceedingly difficult. The decline of the British pound and the near collapse of the German mark illustrate that domestic interventions can stabilize internally but cannot instantly reverse global perception. These patterns are remarkably consistent across time and geography. Whether in Germany, Britain, France, or Italy, debt-fueled monetary expansion leads to inflation, banking instability, and loss of confidence if unchecked. Central banks often underestimate the speed at which market confidence erodes. In historical crises, delays in policy response magnified economic shocks, converting manageable debt stress into full-blown systemic collapse. Geopolitical factors frequently accelerate these patterns. Trade imbalances, reparations, and international borrowing pressures compound domestic fiscal weaknesses, creating an almost inevitable downward spiral in currency credibility. Historical analysis leaves little doubt that economic patterns repeat when underlying structural issues are ignored. Sovereign debt, banking exposure, and monetary expansion interact predictably, providing a roadmap for interpreting modern financial developments. The United States now carries a national debt exceeding $33 trillion, a level unprecedented in peacetime. Despite the dollar's reserve status, persistent borrowing strains confidence and exposes the currency to long-term vulnerability. Treasury issuance has skyrocketed, with government borrowing accounting for more than 30% of total debt held by foreign investors. The reliance on external holders of U.S. debt creates systemic risks if confidence begins to shift internationally. Federal Reserve policies, including prolonged low interest rates and quantitative easing, have expanded the money supply significantly. While these measures stabilize markets in the short term, they amplify long-term inflationary pressures and potential currency fatigue. Foreign central banks are increasingly diversifying their reserves, reducing reliance on the U.S. dollar. China, Russia, and others are actively purchasing gold, euros, and yuan-denominated assets to hedge against potential dollar depreciation. Trade imbalances continue to widen, with the U.S. importing far more than it exports. Persistent deficits require financing through debt, perpetuating the historical pattern of borrowing, currency stress, reserve diversification. Global investors have begun questioning the dollar's long-term stability despite its current dominance. Shifts in perception can quickly translate into reduced demand for treasuries, higher borrowing costs, and pressure on the currency. U.S. banking institutions remain heavily exposed to government debt, creating a direct link between fiscal overextension and financial system stability. Any sudden sell-off of treasuries could trigger a liquidity crunch, similar to historical precedents. The rise of alternative reserve currencies signals a gradual reordering of global finance. China's Belt and Road Initiative and the promotion of the yuan in international trade illustrate a strategic push to reduce dollar dependency. Even small adjustments in reserve allocations have outsized implications due to the dollar's role as the primary global liquidity provider. Minor reductions by central banks in holding dollar assets can ripple across exchange rates, bond yields, and capital flows. Commodity markets increasingly price goods in multiple currencies, reflecting a slow departure from dollar exclusivity. Oil and gold contracts in yuan or euros demonstrate that market participants are hedging against potential dollar instability. Global debt levels, combined with domestic fiscal deficits, suggest that the historical pattern of currency vulnerability is repeating. Structural imbalances, once minor, are now approaching thresholds that previously preceded significant declines in reserve currencies. Inflationary pressures, though currently moderate, could accelerate if confidence in U.S. fiscal management diminishes. Historical patterns show that market psychology often leads real economic indicators in predicting currency stress. International treaties and bilateral trade agreements increasingly bypass the dollar, reflecting geopolitical as well as economic motivations. Nations are signaling a preference for settlement in alternative currencies to reduce exposure to U.S. monetary policy. Technological advances, including digital currencies and blockchain settlements, facilitate non-dollar international transactions. The speed and accessibility of these alternatives accelerate the pace at which reserve diversification can occur. Current account deficits in the U.S. remain persistent, despite decades of policy attention. The continuous inflow of dollars to foreign nations creates a paradox. While global liquidity is supplied, systemic vulnerability quietly accumulates. Debt service costs are now a growing fraction of the federal budget, crowding out spending in infrastructure, healthcare, and social programs. Rising interest payments amplify historical patterns of fiscal stress that have undermined other reserve currencies. The Treasury market, long considered a safe haven, faces subtle but increasing pressure from international portfolio shifts. As confidence wavers, yields may rise, echoing historical sequences where debt pressures preceded currency devaluation. Financial derivatives linked to the dollar magnify the potential systemic impact of reduced confidence. Exposure through swaps, futures, and global lending means that even gradual shifts can have cascading effects across international markets. The Federal Reserve's balance sheet has expanded to over $9 trillion, dwarfing pre-2008 levels. This unprecedented scale of monetary intervention mirrors historical episodes where excessive money printing preceded inflation and currency stress. Modern geopolitics compound financial patterns as nations leverage alternative economic alliances to reduce dollar dependence. Sanctions, trade wars, and strategic diversification accelerate structural shifts that historical patterns suggest will ultimately weaken dollar dominance. Central bank digital currencies may further erode the dollar's exclusivity as a global settlement tool. Digital alternatives allow faster, more efficient cross-border transactions without relying on the traditional U.S. banking infrastructure. Global market behavior increasingly reflects a subtle skepticism toward the dollar, despite its continued use in trade. Patterns of debt accumulation, monetary expansion, and reserve diversification are repeating in ways remarkably similar to past currency declines. Investor sentiment, once secondary to economic fundamentals, now plays a decisive role in the dollar's future. Markets respond to perceived risk, and early signs of caution among central banks foreshadow the structural pressures building beneath the surface. Historical mechanisms provide a roadmap for understanding modern shifts. Debt accumulation, credit expansion, and inflation remain central to systemic vulnerability. These patterns suggest that silent adjustments in reserves and trade invoicing may precede larger changes in global currency dynamics. If the current trajectory persists, inflationary pressures could accelerate as confidence in the dollar wanes. Even modest reductions in foreign demand for treasuries would increase borrowing costs, creating a feedback loop of rising debt service and economic strain. Bond markets, long considered the foundation of global financial stability, could face unprecedented volatility. Sudden adjustments in Treasury yields would ripple through mortgage rates, corporate borrowing, and government spending, intensifying systemic risk. A gradual reduction in dollar dominance could alter the landscape of global trade. Nations may increasingly price commodities, from oil to metals, in alternative currencies, reducing demand for dollars in settlement and reserve holdings. Central banks diversifying away from the dollar could trigger competitive currency adjustments. As reserves shift, the U.S. dollar may face depreciation pressure, impacting purchasing power for both domestic consumers and international buyers. Banking systems remain highly exposed to U.S. sovereign debt, making them vulnerable to shifts in confidence. Even small changes in Treasury market liquidity could stress commercial banks and amplify financial instability. Persistent fiscal deficits and rising debt service create a limited window for corrective action. Delayed policy responses may result in a scenario where market forces, rather than government intervention, drive currency realignment. Investor sentiment, historically a leading indicator, could accelerate market responses. If perceptions of fiscal mismanagement grow, capital flight may occur, further weakening the dollar and creating broader economic reverberations. International trade agreements increasingly bypass the dollar, indicating strategic hedging by governments. This subtle but significant shift reflects a recognition of structural risks in relying exclusively on a single reserve currency. Commodity pricing in alternative currencies may lead to global market adjustments. Nations holding fewer dollars will exert influence over commodity markets, potentially increasing volatility and challenging traditional trade structures. A weakening dollar could spur inflation in imported goods, reducing purchasing power domestically. Consumers may face higher prices for essentials, even if overall wages remain stagnant, echoing historical patterns of currency stress. Bondholders could demand higher yields to compensate for perceived risk, further increasing the cost of debt service. This creates a cycle where borrowing to cover deficits becomes progressively more expensive, compounding fiscal pressure. Credit expansion, if maintained to offset short-term liquidity issues, may amplify inflationary pressures. Excessive money supply can destabilize markets while eroding trust in the currency as a store of value. Global reserve shifts may catalyze a multipolar currency environment. As more nations rely on alternatives like the euro, yuan, or gold, the dollar's monopoly in international finance could gradually diminish. Financial derivatives and cross-border lending could magnify the impact of even incremental shifts in confidence. These instruments link banks and investors globally, meaning local disruptions can propagate quickly across markets. Historical precedent shows that gradual abandonment of a reserve currency often precedes a broader systemic adjustment. The process may be subtle initially, but cumulative shifts can eventually redefine global economic hierarchies. Geopolitical factors will likely accelerate financial consequences. Trade disputes, sanctions, or strategic alliances can magnify currency pressures, making market responses faster and more severe than domestic indicators alone would suggest. Rising interest costs on government debt will constrain fiscal flexibility. Essential programs, infrastructure investment, and social spending may be deprioritized, mirroring historical cases where sovereign borrowing crowded out growth initiatives. Capital markets may recalibrate risk assessments in real time. Investors, anticipating reduced dollar demand, could redirect funds to perceived safe haven assets, further eroding U.S. financial influence.